If you want to understand the value of a nation, don't look at its monuments, don't look at its GDP, look at its currency. Because currency carries the scars of its past, the weight of its present, and the hope of its future. Today we talk about the Indian Rupee, not as a number, not as an economic symbol, but as a living story, shaped by wars, crisis, greed, politics, oil, the rise of US, the fall of empires, tech, and 1.4 billion dreams. Because the rupee has not simply fallen, it has traveled, and this is its journey.
The rupee slid to a fresh all-time low, driven by weaker foreign flows and lingering uncertainty.
The Indian rupee has weakened to its lowest level ever. The rupee has breached the 90 rupees to a dollar mark.
When India became independent, $1 was equal to 3 rupee. And people love quoting that. They use it to say, look how much India has declined. But here is the truth nobody mentions. India was not trading freely. India was not a global economy. There were no open markets. There were no oil imports built in dollars. In 1947, the world did not trade oil in dollars like today. India was part of British sterling area, meaning it used British pounds for most international trade. And most of the oil India imported at that time came from British-controlled oil companies like Burma Oil and Anglo-Iranian Oil. Since both India and these companies were under the British system, payments were made in pounds and not in dollars. And in 1947, 1 pound was equal to 13 rupees. The rupee was not strong. It was simply fixed like a photo frame nailed to the wall. But the day India stepped into global markets, the frame broke because the world was already owned by a different currency, the US dollar. In 1966, after wars with China and Pakistan, droughts and pressure from the World Bank and IMF, India was forced to devalue the rupee by 57%.
क्या बात कर रहे हैं?
That was the first time the country realized something very powerful. A nation's currency does not listen to patriotism or emotion. It listens to reality. In the 1980s, India's import bill exploded. By 1985, the rupee slid to 12. And then came 1991. India had foreign reserves worth only 3 weeks of imports. Gold was literally flown out of the country as collateral, and the rupee crashed to rupees 24. This was not a fall, it was a collapse of an old economic identity. But it was also a rebirth. India opened up, businesses were free, markets were free, imports grew, exports grew, but there was one side effect. Opening the economy also opened the rupee to global storms. To understand the rupee, you must understand the dollar. The US dollar is not just America's currency, it is the world's operating system. 88% of global forex transactions are USD. Around 50% of global trade invoices are USD. Around 60% of global reserves are stored in USD. Oil, gas, metals, tech, licenses, all priced in USD. Even when two countries trade with each other, like say Japan and Korea for example, they settle it in USD. This means every country needs dollar, and when a currency becomes oxygen for the global economy, every other currency becomes a lung struggling to breathe. Every currency reflects a nation's strengths and weaknesses, and India's biggest weakness is very straightforward. We import more than what we export, every single year. Total imports during financial year 2024 and 2025 was at $915 billion, registering a growth of 6.85%. And India's total exports was around $824 billion. If you see the numbers, then in financial year 24 and 25, goods exports was $437 billion and goods imports was $720 billion. That means the goods trade deficit was of $283 billion. And if you see the numbers of imports and exports of services, then in financial year 24 and 25, services exports was $383 billion and services imports was $195 billion. Means services surplus of $188 billion. This reduces the overall deficit but does not eliminate it. Financial year 24 and 25, goods plus services combined, total exports was $821 billion and total imports was of $915 billion. That means overall trade deficit was of $94 billion. And here is the biggest problem. Oil. We import 85% of our crude oil. The price of oil can change the price of the rupee. Every $10 increase in oil prices worsens India's deficit by $16 billion. How? Let's understand this with an example. Let's say India imports 4.5 million barrels per day. This means India imports 1.64 billion barrels per year. If oil prices rise from say $80 per barrel to $90 per barrel, that extra $10 must be paid on every barrel imported. So additional cost is equal to 1.64 billion barrels into $10, which means $16.4 billion. And India ends up paying 16.4 billion more that year. If oil becomes costlier, import bill shoots up, nothing changes on export side, the gap between imports and exports widens, trade deficit gets worse. So if India had a trade deficit of $100 billion, a $10 oil increase may push it to $116 billion. And the payment again in dollar means increasing demand of dollar. This is not economics, it is dependence. And whenever there is a war, a geopolitical conflict, a supply disruption, oil price rises, dollar demand rises, and rupee falls. Whether India does well or not, whether we innovate or not, oil just does not care. India's stock market is huge, but a large part of it is owned by foreign investors. As of 2025, the combined value of equity holdings by foreign institutional investors, FIIs and FPIs in Indian listed companies stood at 75 lakh crore. That is approx $900 billion. And the foreign investors don't love India, they just love returns. So when the US raises interest rates, when investors get better returns there, if Indian markets become unstable or the US puts high tariffs on India, investors get worried. And because of this, they move their money out of India very, very quickly. And in 2025, FIIs and FPIs pulled away around $18 billion. And when investors pull money out of India, the demand for dollars goes up and the value of rupee goes down, because they must convert INR into USD. And this conversion causes massive selling of rupees, massive buying of dollars, and when billions of dollars exit in weeks, the rupee does not work, it sinks. But we cannot ignore the fact that the rupee is not falling only because of these external factors. The government and other key players are also failing in several areas, and we have to accept that these internal weaknesses are adding to the problem.
ये ऐसे नहीं होता मित्रों, मैं शासन में बैठा हूं, मुझे मालूम है इस प्रकार से रुपया इतनी तेजी से गिर नहीं सकता। अरे ये नेपाल का रुपया नहीं गिरता है, बांग्लादेश की करेंसी नहीं गिरती है, पाकिस्तान की करेंसी नहीं गिरती, क्या कारण है हिंदुस्तान का रुपया पतला होता जा रहा है?
If you see, then over the past decade, India relied far too heavily on RBI interventions instead of strengthening the real fundamentals of the currency. Each time the rupee came under pressure, the central bank stepped in to sell dollars and artificially stabilize the exchange rate. This approach created a comforting illusion of control while avoiding the harder work of building export competitiveness, reducing import dependency, and upgrading industrial capabilities. The result is very predictable: short-term stability but long-term vulnerability. And in this 10 years, India also became even more dependent on imports. Despite repeated slogans of self-reliance, Atmanirbhar Bharat, electronics imports surged, making India one of the world's largest buyer of foreign smartphones, components, chips, and solar panels. Chemical imports, battery imports, and APIs imports from China grew very sharply. This is not about old history, it's happening during recent administrations. When a country's import bill rises faster than its export earnings, the demand for dollars skyrockets, pushing the rupee downward. Another major weakness was the unstable export policy environment. Export incentives were introduced, withdrawn, modified, and replaced repeatedly within very short periods. Key commodities like wheat, onion, rice, and sugar face sudden bans. Exporters require predictability to build long-term relations with global buyers, but policy flip-flops created uncertainty and discouraged foreign contracts. As other nations provided stable export frameworks to boost global trust, India's shifting rules slowed export momentum, directly impacting the rupee's ability to strengthen. India struggled to attract deep long-term foreign manufacturing. The decade offered a golden window to the China Plus One trend. Yet multinational giants mostly set up assembly units in India rather than full-scale factories. In fact, even for this, they went to some other countries. Critical components continued to be imported because local supply chains were not developed. The PLI scheme helped, but it was too late and too limited to create true manufacturing ecosystems. And without real manufacturing depth, India continues to import high-value goods and export low-value ones, a structural imbalance that keeps the rupee weak. And currencies rise for only one reason: when the world needs what you produce. Japanese currency rose when Japan became an electronics and auto superpower. South Korea's currency rose when Samsung and Hyundai and LG other all started dominating the world. China's rose when it became world's factory. India's turn will come when we manufacturing electronics, when we build semiconductors, when we export EVs, when we lead renewable energy, when we design global software, when we own patents, when we become energy independent, when nations start settling trade in rupees. This is happening slowly but unmistakably. Apple assembling $14 billion worth of iPhones in India, India becoming the world's second largest mobile manufacturer, solar energy output beating 21 European nations, semiconductor fabs being built, India exporting UPI to multiple countries, UAE accepting rupee settlements, Indonesia and Sri Lanka exploring rupee trade, defense exports crossing 23,000 crore. And these are not headlines, these are currency changing events. So will the rupee fall more? Probably. Will it rise one day? Absolutely. Because currencies don't rise from the speeches, they rise from strength, they rise from capability, they rise from confidence, from creation, from productivity, power. And India is not the country of 1947, it is not the country of 1966, and not the country of 1991. It is a country building factories, it is a country building satellites, AI systems, digital payments, global companies, green energy, aviation, and the world's largest marketplace of young talent. The rupee will rise not when the world wants to respect us, but when the world becomes dependent on what India creates. And that day is not today, but it is coming. Because the rupee is not falling, the rupee is simply waiting for India to become what it was always meant to be. And when India rises, the rupee will rise with it. Every nation does, every currency does. This is not the end of the rupee, this is the beginning of its real story.